Hi folks, I'm Dan Lohmar, CFP professional with United Wealth Management, where we specialize in PR management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley, and I are both pilots for United. Welcome to another video. Throughout my retirement tax planning video series, I've talked about strategies to reduce your taxes and surcharges over your lifetime. One thing I must include in this discussion is a triple tax-free benefit United pilots have available to us, and that is our Retiree Health Account, the RHA. This investment account is one of the greatest tax-favored accounts a person can have. The trifecta of tax benefits. Money goes in tax-free, it grows tax-free, and when you use it to pay for qualified medical expenses when you leave United, it comes out tax-free. This is huge, but it does not come without one possibly big drawback, and that is it's a use it or lose it account. Whatever amount is not used remains in the VEBA trust and cannot be passed on to heirs. With that in mind, two big things to know about the RHA: how much you might have in it upon retiring and how long it'll take to spend it down. And a big part of that is knowing what retirement healthcare costs will be. That's what this video is about. But before we get started, remember to subscribe and hit the bell icon so that you get notified when new videos come out. All right, so what do we need to know about the Retiree Health Account? Obviously, it's for educational purposes only, so don't take this as tax, legal, or investment advice. Seek your own advisor for your particular situation. We're talking about the Retiree Health Account, otherwise known as the RHA or the VEBA. The VEBA is the Voluntary Employees Benefits Association. That's the trust that actually manages the money inside the Retiree Health Account. Why is this important to know? I still run into people who don't know much about it. They asked me, what's this retiree medical health benefit thing? And so I still think the word needs to be put out there. So it's another reason it's important to understand it. But retiree healthcare costs is another big thing. I think they are often overlooked when it comes to retirement planning and underestimated how much they're actually going to be, especially with the healthcare inflation rate. And then there's some differing opinions about the RHA, and completely understandably so. I think the majority of pilots are going to benefit from a high RHA balance, but there's definitely a few who will have high RHA balances. They may never spend that amount of money. But I'm just here to give some neutral information and try to put some perspective, particularly on healthcare costs and what the account can be used for. So the RHA is the Retiree Health Account. It's used to pay for qualified medical expenses when you retire from United. So what's great about it? What's so great about it? It's triple tax-free. Money goes in tax-free, it grows tax-free, and when it's used for qualified medical expenses, when you leave United, it comes out tax-free. What's the downside about it? It's a use it or lose it account, so it's not an inheritable asset, and that is what some of the concern is about. So who's it for? It's for United pilots after they're retiring from United, and then eligible dependents, so a spouse or any qualifying dependent children. Where do you find my RHA balance? I get asked that a fair amount, and that is it's on Flying Together, Employee Services, YBR, and you pull up that page, it should be, your account balance should be shown right there, upper left-hand corner of that screen. So what are qualified medical expenses? Generally would be any medical expense that qualifies for medical and dental expense deductions. It's outlined in IRS Pub 502 if you want to really research into it, and there's quite a few listed there. The other thing I'll add about this is our account is dictated by the IRS rules of what's called an HRA, or a health reimbursement arrangement. And I just want to throw this in there because under those rules, there's no voluntary contribution. So I know there's some discussion about, well, why can't I opt in or opt out of this account? Well, under the IRS rules, it's all non-voluntary, so we don't have the option to opt in or opt out. Just want to throw that out there also. So the qualified medical expenses, what are the biggies? These really add up. Medicare Part B. So for a couple in 2019, that's $3,252 per year. United Retiree Medical for a couple, $7,212 per year. Out-of-pocket costs are United Retiree Medical and Medicare does not directly cover vision and dental care. And so those would be other policies you'd have to pick up. And then also out-of-pocket costs, probably at about $1,000 $20,000 per year might be a place to start. That's going to vary according to your situation, obviously. And then there's also another expense that qualifies are qualified long-term care insurance premiums. It's up to certain amounts. And without getting into a discussion of what a qualified long-term care insurance premiums are, what actually qualifies those, the one thing I'll say is if you have a hybrid policy, so that's kind of a combination between long-term care and life insurance, those generally are not qualified contracts. So just to throw that out there. But as you look at the big expenses, you take these four big categories and add them up, and you're going to start to have some pretty hefty healthcare costs when you retire. So approximately for a couple, you're looking at $12,500 per year. That's with no long-term care coverage. A single person is half of that, and then that's assuming that your modified adjusted gross income is below the $170,000 limit, because once you go $1 above that, then you increase your Medicare costs. And I've got a video about Medicare costs and what the IRMA threshold is as a previous video. So look at some basic costs there. When you also consider healthcare inflation, long-term average is 5.3%. That's what we use for planning purposes. So 10 years from now, you're looking at those healthcare costs, $21,000 a year, roughly speaking. 20 years, $35,000 a year per couple. So that's quite a bit. So if you look at just those alone, you can imagine that those can start to burn through some RHA balances fairly quickly. How is it funded? So it's funded a couple different ways. First of all, there's no voluntary employee contribution. So we as pilots cannot elect to have money put in there directly. It's a non-voluntary contribution. So we have $1 per hour of pay that's taken out of our paycheck. And that contributes to it. The other way is spillover and vacation forfeiture. So like I said, the base funding, everybody has $1 per hour of pay that goes into their RHA, and that is regardless of what fleet, seat, or your seniority is. So if you fly 1,000 hours a month, you're going to have 1,000. I should say if you're paid 1,000 hours a year, you're going to have about $1,000 per year put into the retirement health account. The second way is spillover, and there's two ways that the money spills over into the RHA. But basically what we're saying is spills over from the PRAP into the RHA. There's two ways that happens. Is the IRS says any compensation above $285,000 cannot be looked at for contributions into a 401k. And so what happens is once a pilot's income, if your income goes above that amount, once a pilot's income goes above that amount, then the 16% company contribution now goes into the RHA instead. And the other limit is the PRAP limit, and that is contributions can only hit so much in the PRAP per year, and once all those limits are hit, then the money again spills over into the retirement health again. I'll show you here graphically in just a second. So what it looks like is compensation spillover, all income below $285,000, 16% of that United puts into the PRAP. Once a person hits 285, if your income goes that high, then the IRS will no longer allow contributions from that income above that threshold to go into it. So those contributions go into the retirement health account. So what that means is 16% company contributions, maximum allowed $285 of compensation means that the most the company can put into the PRAP is $45,600, and that's again these are 2020 numbers. So if for an example you made $70,000 more than the compensation limit, 16% of the $70,000 goes in there. That means $10,400 would spill into the retirement health account. Here's the other way to look at it: is as money goes into the PRAP, as you can look at the account here, money goes into it throughout the year, and you start hitting these limits. Pre-tax and Roth limits get hit at $19,500 and $26,000 depending on your age. The company continues to put money in, and once these higher limits are reached, depending on your age, once that's capped out, then United contributions go into the retirement health account. The R&I has a great calculator on the Apple website that if you want to kind of figure out what your contribution rate is, and when you're going to start to max out and what your maximum rates are going to be, what your spillover is going to be, they have a calculator to do that. And we have one we use here at United Wealth Management as well. And that one is just as an example. Here's a narrow body captain, find 90 hours per month. And I just put that number out there. So he's getting paid 90 hours per month. And I'm just going to show it as 0 and 0 because this shows you here that he has spillover late in the year of a little over $3,300. If you look at the graph here, you can barely see it. There's a purple spillover. The purple is the RHA spillover. And so that is spilling over because he reaches his compensation limit in November of that year. And if he decides instead he's going to contribute and he wants to put a lot into the PRAP, he front loads. He wants a lot of spillover. As you can see here, the blue contributions are Captain Joe's. He is maxed out on the PRAP by the end of February. And then the red graph is United contributions. As you can see, they go in for the rest of the year. And he has quite a bit more spillover. He has $11,000, more than $11,000 in spillover. So that's graphically the way to look at it. And that's the calculator we use here at United Wealth Management. So it kind of summarizes those two things. If you want to maximize your RHA spillover, max out your PRAP contributions early in the year. It's going to hit those PRAP limits earlier in the year, and that many more months that United contributions have to go into the retirement health account. And if you want to minimize spillover because you're concerned about having too much in there, then for those making over $285,000, the amount that you can put into the PRAP without causing additional spillover by your own contributions, that would be $17,900, and if you're under 50, it'd be $11,400. Another thing to think about with this is that Roth contributions are after tax. And so it's the same, if you make Roth contributions, it's the same nominal amount, so you're not going to create more spillover, but the money that's in there is all yours, so it's already been taxed, and so essentially it's a larger contribution because when it comes out, it's tax-free. It's a Roth contribution, so that's just something to keep in mind. If you're trying to save more, but you're concerned about having that spillover. So the third method is vacation forfeiture. So the company just came out with this note about making your election, and if you have vacation that you're going to forfeit for training or whatever reason, then you make your election. It automatically goes into the PRAP, but you can elect to have it go into the retirement health account if you choose. How much could a person have upon retirement? Very, very hard to make a projection or state an average of balance across the pilot group because there's so many variables. Largely depends on career path, seniority progression, spillover desires. And what we do is we just look at it and assess it each year. What's your RHA balance? What is your career path from this point? And I don't really get too concerned about it with any clients about having too much in there. And I would just guess that probably around $100,000 we start taking a closer look at it. Below that, if a person's concerned, we certainly take a look at it. But too difficult to say over the course of a career what a person is going to end up with. So again, how long, not how much are you going to have, but how long is it going to last? Again, it depends on your situation. Are you married? Are you single? TRICARE, United Retiree, medical, and do you have any long-term care insurance premiums? So the person who's going to spend through it the fastest is going to be married, on United Retiree medical and probably paying for long-term care insurance premiums. And then the person who's going to have the longest spend out period is going to be a healthy single person on TRICARE because they have relatively low spending expenses. The other thing I'll say is I hear some folks say, hey, I'll never spend that amount on healthcare in my life, and it's very possible. But before you do, just take a close look at what your healthcare costs are going to be. So I think a lot of times they're underestimated and or overlooked, and then also account for healthcare inflation. $100,000 might seem like a lot in there if you're coming up in retirement, but if you do the math and kind of run some projections based on what your healthcare costs are going to be, it may not be as much to you. And the other thing to think about is It might appear that there's going to be a lot in there, but consider too, what if you went out early on disability, you went out at 60 or 61 or whatever, and you didn't have nearly as much in there as you thought you're going to be. If you go out on disability, you have access to it, and it would be more likely your healthcare costs are going to be a little bit higher because of that. So just something to think about. And then I always do a projection of if a person's concerned about having too much in there, I always ask, all right, well, if you had taken that money as after-tax income instead of it going into the RHA, and you saved that into a taxable, or you designate it as a healthcare account, because you have healthcare expenses regardless of whether it's in the RHA or not, I always ask, all right, what would that account balance be, and how long would it take to burn through that? Because once you get past that point, now you're in the same boat you would have been in before. Instead of leaving potential money in the RHA, you've just paid more taxes to the government, and you're in the same situation that you're trying to avoid. So here's just a couple hypotheticals. Captain Joe retires this year. He has qualified healthcare expenses at $12,500, and he's paying for a long-term care insurance premium at a level premium of $3,600 per year. And we'll assume his RHA grows at 5% a year. It's conservatively invested. So he retires. He has a $300,000 account balance, and he would be projected to run out at age 87. And again, if he had not taken that money, if he had paid taxes on that money and taken it as income and set it into a taxable healthcare account to pay for healthcare costs, and invested the exact same way that the RHA is invested, then that account would be run out at age 79, which means every year he lives past age 79, he's essentially, without an RHA account, he's essentially in the same boat that he's concerned about having too much in there. In other words, over his lifetime, he's now paid more in taxes and in healthcare costs than what he would have saved in taxes had the money just gone into the retirement health account. So it's just a perspective to kind of keep things in mind there. And again, there's some varying account balances there from $300,000 down to $165,000. Just to give some reference of how long it might take to spend the RHA down. And I would say in this situation, he's more on the end of having higher healthcare expenses. Again, different situation here. This time, Captain Joe is not on United Retiree Medical. He's on TRICARE, so his expenses are quite a bit less. And in this situation, $300,000 in his RHA is absolutely correct. He's concerned about having too much in there, and he has right to be, because he doesn't spend the entire amount down. But then if he had $200,000 in there, it would last till 90, and the taxable equivalent would be about 80 years old. So if he was concerned about having too much in there, he rightfully has that concern. And that's when you start to try to take a look at it early and ask yourself, should you minimize your PRAP contributions? And here's another thing too. I hear some folks say, hey, I'm going to pay for long-term care with my retirement health account. And those are qualifying expenses. The thing to keep in mind, that long-term care, let's just say it happens 15 years after you retire, and you look at the inflation rate on that, it becomes a very large expense. And almost in every scenario I've run, that the RHA gets depleted in the first year of a long-term health event. So if you're concerned about long-term care, I would be more inclined to buy a long-term care insurance policy rather than trying to fund the entire thing with the retiree health account, because it would deplete it very rapidly in that case. Here's the other thing I'll just say is that for a younger, say like a first officer, beware of if people start talking in nominal account balances. So $300,000 for a captain retiring today might very well be a lot in there. $300,000 account balance for an FO retiring in 20 years is not nearly the same, because his or her healthcare costs 20 years from now are significantly greater than what they might be. So just be careful about talking about using nominal account balances. And again, it's always very personal and depends on every person's individual situation. So the conclusion here I'll make from about the RHA balance is, one, explore what your qualifying expenses are. Know what they are before you automatically jump to a conclusion whether you're going to have too much or not enough. And again, don't think in terms of nominal balances, because time frames, depending on who you're talking to, vary widely. So always relate it to your personal situation. A long-term care event in almost every situation will deplete the RHA very, very rapidly, probably within a year or two, if there's even money remaining in there at that point when it happens. So I still think long-term care insurance is probably a better option rather than counting on the RHA to pay for long-term care. Long-term care itself, and then what's your break-even point. So if you are concerned about having a large RHA balance, I would ask yourself, what is my break-even point that if I had that money come to me in a taxable account and I invested the same way, how long would it take to burn through that? Because now once that account is burnt through, you're basically in the same situation where you're paying more in healthcare costs, and that's less that you're going to be able to pass on to your heirs. So that's kind of the RHA summary. There's a lot going on there, but like I said, I still get a lot of questions about just really basic questions about the RHA, and I just thought this would be to take a good way to kind of take a little bit deeper dive into it and answer some of those more common questions. So in my next video, I'm going to talk about doing what are called in-plan Roth rollovers, and one reason I want to talk about that is, one, it's not a commonly known step that we can take in the PRAP to get more money in there than the IRS actually wants us to have. And then it also is another way to maximize RHA spillover if that is something that you want to do. And so when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. As you can see, it's very important to know the benefits of RHA and how those benefits pertain to you. Every person's situation is different. With that said, some people want to minimize spillover and others want to maximize spillover, and that's what my next video is about. And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. And if you're a United pilot and want to talk informally about how I can help you, shoot me an email, dan@unitedwealthmanagement.com, and let me know what's on your mind. Until next time, invest with a plan based on science and evidence. Everything else is just guessing.